The gold price during the past 18 months, actually the past 24 months, is a clear indication that we are nearing the end of the rainbow, in my opinion. Let's use a mathematical approach. Excuse me, but the federal government's on-balance sheet liabilities, not including those of state and local governments, exceed $37 trillion. I won't even go into other economies because they're in far worse situation. The truth is even worse, but that's the figure that the haters use. Rather than 2022 or 2023, I would argue that the march of gold started in the year 2000. You may recall that 250 Oz was the price of gold 25 years ago. Gold has served its purpose, at least in nominal terms, since its value has grown at a compound annual rate of 9% for the past quarter of a century. According to reports, the US dollar index fell sharply in 2025. Over time, the buying power of the US dollar has been substantially diminished when compared to gold. A decline in the economy has always been accompanied by a spike in gold prices. So far this year, gold prices have climbed more than 50%, giving traders who hold the safe haven investment massive rewards. Many experts have warned ABC News that the recent surge in gold prices might signal a recession in the American economy. Investors are fleeing paper assets for physical riches, according to renowned market expert Rick Rule, who predicts that gold will keep increasing. Soft oil and gas prices are examples of how he characterizes the US economy. Uneven, robust for skilled workers, but weak overall. Calls to lower interest rates amid persistently high inflation indicate a shift in strategy. What Rick sees as the most telling indicator of growing political influence over monetary policy is that very thing. Therefore, there is not a single cause that is driving the outstanding strength of gold this year. Persistent inflation, uncontrollable debt, and the politicization of rescue institutions, a deadly cocktail. Rick Rule, a seasoned investor in natural resources, claims that the time of reckoning has come. The awful simplicity of the math behind the US budget realities is what it comes down to. The United States currently owes $37 trillion in its official debt. However, the mountain of unfunded liabilities totaling $120 trillion is the true disaster. According to Rick, the Federal Reserve has already decided to engage in inflationary default, which is dishonest. It implies that the loan is being repaid with a currency whose value diminishes annually. Up to 75% of the dollar's buying power could be lost in the following 10 years. That's why gold is serving its purpose as the last line of protection against a government that can't pay its bills. Prior to delving into Rick Rule's astute observations from his most recent interview, ensure that you never miss a moment when truth meets market by hitting the subscribe button and tapping the bell symbol. All right, let's dive in. In my opinion, the economy is in a state of flux. Specifically, I'm thinking of the American economy. The tariff issue is fraught with self-inflicted wounds. The economy as a whole is doing really well. Those who possess highly marketable abilities will actually benefit from it. Many people in the United States lack marketable skills, which is a major problem. The general economic situation is weaker than some would have you believe, according to the recent downturn in specific commodities, especially oil and gas. An economic downturn has not occurred in an extremely lengthy period. I am not an economist. Thus, this is not a recommendation. Simply put, if the US economy were robust, the price of oil and gas would be greater in comparison to output plateaus. I should mention that there is a lot of political pressure to lower interest rates in the US, even if the economy is rather healthy. This is quite strange, considering that CPI-stated inflation is fairly substantial, and the economy is generally doing well. The economic climate in the United States has become more politicized. The extraordinary strength of the gold and gold equities markets this year may be accurately and simply explained, in my opinion, by adding inflation and politicization to the debt and deficits experienced by the United States and other countries. The gold price during the past 18 months, actually the past 24 months, is a clear indication that we are nearing the end of the rainbow, in my opinion. Let's use a mathematical approach. Without include state and local governments, the federal government's on-balance sheet liabilities in the United States surpass $37 trillion. The truth is even worse. But that's the figure that the haters use. The Congressional Budget Office estimates that the off-balance sheet liabilities of the United States government, which include entitlements, Medicare, Medicaid, Social Security, federal pensions, and military pensions, amount to $120 trillion. Before they do things like pay salaries or bomb foreign nations or whatever it is they do, the total revenue that goes into the federal government, gross federal income, is only $5 trillion, which puts that $120 trillion in perspective. With $5 trillion in revenue before expenses, you're aiming to pay off a debt with a net present value of $120 trillion, not a nominal value. That is ineffective. The US can take one of two possible exits. An honest default would be to inform the bondholder that they are aware of the $37 trillion debt, but do not possess the necessary funds to pay it. So you're telling people who get Social Security, Medicare, and Medicaid benefits, like say Rick Rule, that we get it. You paid into the system for 60 years, but because of budget cuts, we'll have to back out of some of our commitments. There will be no such thing as an honest default. We're currently engaged in a deceitful default in which we pay our bondholders and entitlement recipients what they're owed in nominal terms, but artificially inflate their net present value. Absolute value-wise, I expect the US dollar will lose 75% of its buying power over the next decade. This is not related. In my opinion, the US dollar will fare rather well when compared to the following currencies: the pound, sterling, Canada, and Australia. Nations that are in a similar situation as the US but may be less resilient. In my opinion, nevertheless, the value of the US dollar drops by 75% when measured in absolute terms. We've lived beyond our means for 40 or 45 years, and that's the result. I believe that the price of gold reflects that. The price of gold has increased nominally from $250 per ounce in 2000 to a sum greater than $3,700 now, but I am not sure that this is accurate. The gold price is up 9% compounded, which is a significant increase, but I'm not sure it's really up that much. In my opinion, the rising price of gold is a reflection of the declining purchasing power of the dollar, which is caused by the loss of faith that savers around the world have in the stability of the dollar, which is a result of our society living beyond its means. When asked what would make me sell my gold, I usually respond that the problem would have to go away. The United States could have a balanced budget if I thought there was a shot. Just so you know, the deficit in the budget is now over $2 trillion. I would sell my gold holdings if I believed that the entitlement liability could be politically resolved, or if I perceived positive real interest rates in the US. By positive real interest rates, I mean an interest rate on the US 10-year Treasury that exceeded the rate of depreciation of the US dollar. Although the Consumer Price Index, CPI, the official statistics on inflation, indicates that inflation, as defined by the United States government, is 2.9% per year. Inflation being the decline of the purchasing power of the dollar relative to the goods and services purchased by American families. I maintain that this is not necessarily the case. Using that metric, I would argue that the buying power of the US dollar is falling at a compound annual rate of approximately 8%. If the 10-year US Treasury were to yield a real interest rate, it would have to be higher than the rate of depreciation of the currency. At the moment, The yield on the 10-year US government is around 4.5. The US 10-year Treasury would have to be yielding 10, 10.2, or 10.5 for me to sell gold, and I don't think that will happen. Negative real interest rates, on-balance sheet and off-balance sheet liabilities, and the requirement to print money to meet the nominal value, rather than the real value, of these obligations would cause the purchasing power of the US 10-year Treasury to fall by 75% over a decade, and I would expect the nominal price of gold to reflect that fall as well. After years of underinvestment and a dramatic increase in demand due to electrification, AI development, and rising energy availability in emerging countries, Rick Rule is quite optimistic about copper. He warns that the value of already established copper operations will rise as a result of inflation, which would drive up mining costs. Gold and copper prices are predicted to keep going up in 2025, according to market analysts. This is because of a mix of factors, including geopolitical risk, supply limits, and increasing demand. On Thursday, gold prices increased slightly, while staying mostly inside a trading range that was previously created. US copper prices, on the other hand, continued their upward trend, following President Trump's confirmation of duties on the red metal. Rule is skeptical that the US deficits can be reduced without instituting difficult changes. He thinks interest rates will be determined by the market, leading to budgetary constraints like those in the 1980s. In the long run, he anticipates that the United States will have to deal with unsustainable promises, which will lead to greater taxes, means testing, and eligibility age increases for entitlement systems like Social Security. The interview can wait. Take a look at those ratios. For commissions or newsletter sales, I find them intriguing. However, in my opinion, these are distinct types of assets. I am well aware that the cost of producing copper, and more specifically, the capital cost of constructing new copper infrastructure, will rise due to inflation, specifically the type of inflation I am referring to. Clearly, that will affect supply and pricing, supposing demand remains steady. A copper bull here. There are two main reasons why I am a copper bull. For the past 3 decades, we have neglected to adequately fund copper-related endeavors, such as copper exploration and development. Undoing that sin will take time. Presently, there is a shortage of copper relative to demand, and this situation is likely to persist, barring a worldwide economic downturn. There will be an increase in demand. We Westerners consider topics like artificial intelligence and electric cars. In the West, we tend to ignore the idea that 1 billion people lack access to basic power since it doesn't directly impact us. 20 or 25 years from now, they will understand. A literal and metaphorical mountain of copper, copper for production, transmission, and of course consumption in the home, will be needed for that. Regardless of the price of gold, the demand for copper will remain high for an extremely long period, and the supply of copper will be limited. It is also important to think about how inflation would affect copper. Over the next 15 years, we will need to construct numerous copper mines. At least in terms of nominal US dollars, the cost of developing those copper mines will not increase. It will detonate. The initial investment required to construct a porphyry in South America, which is now estimated at $7-8 billion, will quickly increase to $10, $12 to $14 billion. The elimination of the need for initial capital means that assets with a longer lifespan and the ability to generate income are actually worth a lot more than people realize. At the tail end of the 1970s, we Americans dealt with it. A lot of people were shocked when we let the interest rate reach market levels, that is, 18%, because it went against inflationary forecasts. Government was not shrunk in absolute terms, but its growth rate was slowed. Even though it boasted an anti-government position, politics scuttled the Reagan Revolution. While we did not shrink the federal government in any way, we did significantly slow its expansion from 1980 to 1992. Because of that, the economy was able to expand at a rate that made our collective foolishness more manageable. I would not be surprised if the events of the following decade mirror those of that time. In the end, I think the market, and not the Fed, will decide on the long-term interest rate. Regarding the cost of capital, that will have fairly significant ramifications. In a decade from now, I'm hoping we can rein in the expansion of the national debt by reducing the pace of increase in government spending. Regarding entitlements, I believe we will change them. For instance, I believe that when it comes to Social Security, they will tell some big old wealthy person named Rick Rule that the concept that your Social Security taxes will cease at an income of $160,000 will be eliminated. Like everyone else, regardless of their earning level, you will be required to pay in. Put another way, hard-working citizens should expect a hefty tax hike. Secondly, they will assess my situation and inform me that they will conduct a means test to see whether we can afford to pay you, regardless of the amount I put in. They're going to tax people like me and then do nothing with the money we put into Social Security. It's a straight transfer. Theft describes that. We may expect that to transpire. Additionally, the number of years that can be used to qualify for Social Security would be increased, and all entitlements will be subject to a means test. Income at or below the poverty line beginning at age 65 was the original intent of the Social Security program when it was established in the US. The average life expectancy of a male American when Social Security was first established was 66 years, so that's a significant statistic. It was the intention of the program to keep the typical American from falling into poverty for a year. There has been a considerable improvement in the average lifespan of men in the United States. As a result, the minimum age to qualify for Social Security benefits needs to be raised. It should be increased from 62 to 70 or 72 at the very least. That must take place. My prediction is that it will occur somewhere in the next decade, not in the next 2 or 3 years. In the last 5 years, the national debt of the United States has grown by $10.83 trillion. Gold prices have soared to $4,000 as of October 10, 2025, a rise of 110.40% over the previous 5 years and 53.78% over the previous year. According to experts, gold presents investors with a volatile financial landscape. They also mentioned that alternative assets, which are usually considered to be low-risk investments, have been unsettled due to stress in long-term bond markets and a depreciation of the US dollar. The price of gold could hit $10,000 per ounce in mid-2028 and early 2029, according to its trajectory since late 2023. Is the world subtly ushering in a new era where gold and real commodities reshape the basis of global wealth as trust in paper money dwindles and tangible assets ascend? Feel free to share your opinions in the space provided. If you enjoyed this video and found it helpful, please consider subscribing to our channel and enabling notifications so you never miss a video. Watch this video, and we'll see you later.